Welcome. So if you're interested in Mastercard, perhaps you're looking to buy them, they're on your watch list. Maybe you're unsure whether or not you should sell them. Come to the right place, then we've got the answer here on Finance with JCL. So we'll start off with rule number one, which is don't lose money. And we look at Mastercard, look at their financial health on Morningstar. The debt to equity is increasing. That's the levels of debt are going up. The current ratio is consistently above 1. If you look at that in pictorial form here, you can see the red line there of the debt is notably increasing over the last 5 years, whereas the equity is relatively stable. Not a great start. I'm not suggesting an imminent risk of failure or anything of the sort, but is compared to Visa, this seems a bit worse in terms of the debt situation. At the end of this video, I will link to Visa, which is a video I've just done, so you can compare the two. Right, financial history, and that revenue's gone from almost 7 billion up to 15 billion. So 2 billion net income up to 6.5 billion, so that's over trebled in 10 years. Dividends from 6 cents to 164 in the trailing 12 months. So it has dipped down from the 2020 number, but nevertheless, much higher than it was. There's been exponential dividend increases. And that payout ratio is only 25%. So much like Visa, they have got room to double their dividend fairly easily if they wanted to. And again, much like Visa, the number of shares here has been decreasing. So around about a billion shares, so they've been doing share buybacks. And again, good operating cash flow as a proportion of their revenue. Very little capex spending as you expect. It's all digital. So the free cash flow is $6 billion. We'll need that figure later, so the valuation is coming up, so stay tuned for that. Profitability wise, those net margins are very nice, consistently above 30% since 2012 and often above 40%. And the return on equity is over 100% in recent years. And that return on invested capital is high as well. So what we're seeing here is a very profitable business, and it's a business that invests into itself well. That's probably why that dividend is low. Why would you pay out a dividend to someone when you can invest back into your business and get a huge return? So let's have a look at the valuation. First of all, look at the PE and then coming up to the discounted cash flow. Now, looking at the price to earnings ratio, so comparing the price to the earnings, it's 60, which is very high. Forward PE is 38, which is a little bit more reasonable, although still a little bit on the high side. And we have a look at the analysts. So first of all, we have 33 analysts. This is a well-covered company, and there has been some surprise factor in most of the recent earnings reports. So they've done better than analysts have expected. The trend for the analysts is very much buy and strong buy consistently. And they're suggesting over the next 5 years growth at 21%. And in the past 5 years, it's been 22%. So it's consistently carrying on as it has done, essentially. Is that realistic? Now, the market cap's just under $400 billion. So I think, it could potentially grow at 20% a year for about 5 years. Look at a different set of analysts on Simply Wall Street, they're saying 18.8. So I think I'd be comfortable saying 20% a year for the next 5 years seems like a decent growth rate. Now, the forward P is 35, the current P is 60. So compared to that, you probably want those numbers to be a bit lower. But this does command a premium, this company, because it is so well known around the whole world. Margins are incredible and they're great at reinvesting into the business. So you could understand why there's a premium valuation compared to what you'd expect from a company growing at this rate. Right, we'll have a look at the discounted cash flow. I'm going for 5 years of growth. And the 4P is 38. So if we said terminal multiple 38 as a starting point, market cap there 390 billion, and they have done some more share buybacks. They've got 983 million shares, and the price is $393. You have a look at that for the last 5 years. It's straight up trend, and there's a couple of dips here, particularly when the pandemic came when it was 211. So if you bought around that sort of time, you've enjoyed a fantastic return. So I've entered 20% into the template, and if you want to access the template, you can do so via a couple of the links below, via the Patreon or the Buy Me a Coffee link. Now, what we're saying here is the raw free cash flow is going to go from 6 billion up to 15 billion at the end of this period. So impressive growth there. That leads to an intrinsic value per share of $417. So it's actually roughly fairly valued according to this discounted cash flow. Do a bit of a back pocket check on Simply Wall Street, bit of a sniff test. They're saying 324, so slightly overvalued. I think it all really depends on if you believe you could sell this for a terminal multiple of 38 5 years' time. You might think perhaps 30 is a little bit more of a reasonable number. And if you go with 30, you're looking at 339, which is, again, slightly overvalued. There we go. So that's Mastercard. I think it is, yeah, probably a touch overvalued for a 10% a year return, but it is a great company. It's going to keep growing very impressively. And it's one of those where if there's a bit of a dip, it becomes quite an interesting buy. Now, is it better than Visa? Interested to hear your thoughts. Comment below if you think it is better than Visa. And I'm now going to leave a link on screen so you can go and watch the Visa video, part of the company valuation box set on the channel. And then you can make your own mind up as to which you think is the superior investment. Cool, so thanks for joining me, and I look forward to seeing you on the next one.